All right. Hey, everyone. Jason Dalby here with Compass Real Estate Dalby Group in Denver, Colorado. And today we have Drew Boland on. And Drew is a local loan officer with Proper Rate and has experienced I would say, a pretty monumental growth in your business over the past year. Is that right, Drew?
That's right. That's right. It's been a fun run the last 12 to 24 months.
Well, congratulations on all of the success. I'm sure that has kept you on your heels.
Thank you. Appreciate it.
And I appreciate you coming on. So, I recently got asked by somebody who is looking to start investing in some properties and opportunities around town, and she didn't really know where to start. So she submitted some questions to me, and rather than pretend to know all of the answers or at least make up the answers, I wanted to bring you on and you could let us know the exact answers and how, she can start to pursue this and anybody else who's watching this. So,
Absolutely.
So obviously you are a residential mortgage broker, correct?
That's correct. Guilty.
And so what is, what qualifies a residential property? What does that actually mean?
Up to 4 units.
Okay.
Anything above 4 units is considered a commercial property, and they need to be looking at commercial financing.
Okay, and so that's a totally different product. Anything over 5 and up, correct?
Yeah, 5 and up is when you're in the commercial space. Totally different animal, different loan options, different terms, different requirements.
Sure. So when I bought my first property, it was a 3-unit building, and I used a residential loan, FHA financing. I only put like $15,000 down, which was incredible at the time, but also actually a lot of money for me at the time too. Yeah. And so, so let me know how that works, right? Like you can use an FHA loan, and actually, can you expand on what qualifies or what is an FHA loan?
Yeah, so that's a super smart play by you. Okay.
Thank you.
And if you hear of people talking about like house hacking, that's a big part of a younger person or a newer homeowner house hacking. And the reason for that is FHA is only available to primary residents. Okay, so only for a property that you are going to occupy as your primary residence. Okay. You can't buy an FHA property, or you can't buy a property with an FHA loan as a rental, as an investor. Okay. So the reason why I say it was a smart move by you and why house hackers talk about it is that, look, like, at a fairly young age or at a point in your life where you were comfortable living in, say, one apartment of a 2 or 3 or 4 unit building, right, and renting out the others, FHA is a great option for you. It's a great way for you to dip your toe into that kind of real estate investing world without a ton of money, without needing a bunch of capital to get into it. So go ahead.
Well, I was just going to say, it is such a capital intense industry and product that anybody should try to get a discount if they can, whether that's on the financing or the price or, however it comes to them, right? So
absolutely, 100%. And it's just hard for a lot of people, especially people who have never owned property before, to save up enough money to buy a multi-unit, buy a 2 to 4 unit building with enough and have enough down payment to do it as an investment property. Okay.
Right.
So, to put that into perspective or put some parameters around that, FHA will allow you to buy a 4-unit property with as little as 3.5% down. And I don't know all your details, but I'm assuming that was the scenario you were in. Okay.
Yeah, exactly that. Yeah.
Again, because it was owner occupied, you had that ability to do that. I did a similar thing at a certain time in my life. I wasn't a first-time home buyer at that time, but some things changed in my life, and I had an opportunity where it was, look, I don't own any other property. I'm willing to move into an apartment instead of a home and be able to rent out the other units. Now, that was 9 years ago that I bought that property. I still own it today. Okay, and I haven't lived in it in years, right?
Yeah.
So FHA allows you to get into that space, right, at a lower down payment. Now the intent is you have to occupy the property within 60 days after closing. Okay. And the intent is that you stay there for a year. Okay. With that said, there are no requirements that you like continually prove that you're still living there, and you wouldn't have to like, a year or 2 or 3 down the road, if you move out, you don't have to change anything with your financing. That loan is there on that property to stay. Okay.
So if I wanted to do it again, though, right, I would have to refinance out of an FHA.
That's
So
correct.
what? So if I wanted to use that loan product again, correct? Correct.
Correct.
Because you can
Correct.
only have one.
You can only have one FHA loan at a time. Okay.
Okay.
And that's where it does get a little bit tricky. And for most people, life will get in the way of being able to do this repeatedly, right? It's like you're either maybe you're going to want to move into a house and not want to move into another apartment, building, right?
Well, I would
Or
say our worst mistake was not doing it again,
it's
right?
sure, sure,
I wish
sure.
I wish I would have just rinsed and
Yep,
repeated that
yep.
whole process, and I didn't, and it is what it is. But
Well, particularly in a market like we've seen in Denver over the
right,
last 10 years, that this market here in Denver has actually allowed more opportunity for that than we would normally see in a very traditional stable real estate market. And the
right,
reason being is that property values have continued to increase, right? Continued to appreciate. So what you could have done is gotten in that place, owner occupied, FHA, whatever, and at some point, if you built enough equity to where now you had 20% or 25% equity in it, you could have refinanced it into a conventional mortgage. Okay.
yep,
If you were still living there, you could have refinanced it into another conventional mortgage with the primary residence. Then you would technically, have to intend to stay there another year after that. Okay. But let's say
right,
you did. Let's say you spent a year or so or 2 in that FHA loan living there, and then the property appreciated 15%, 20% in that time. Now there's probably an opportunity for you to refinance it onto a conventional loan, stay there a little while longer, and then move out and buy another place FHA. Okay.
yeah, yeah,
Um, Alternatively, you could also have moved out and just refinance it as an investment property. The only
right,
difference there when you're classifying a property as investment property is you need a bigger down payment or more equity if it's something you
right,
already own. And the interest rate's a little bit higher than it
sure.
would be on a primary residence.
So one thing that we did, I mean, we benefited from great timing in the market.
Hmm.
That market hasn't existed here when we bought that in a very long time. But we also forced appreciation by improving the units,
Yeah.
raising the rents, and so as people go to appraise that, obviously it's worth more now than it was when we bought it because we improved it and raised the rents, and so it's making more money than it was, right?
Yep. For sure.
So.
For sure.
Um, so how does somebody go about qualifying for an FHA loan?
I mean, FHA actually has the lowest qualifications of really any loan product out there in the residential world. And what I mean by
Okay.
that is it's got the lowest requirement for a FICO score. Okay. So
Okay.
FHA will allow you to get a loan with as little as 580 credit score.
Okay.
Now, there's other factors that go into play, and not everyone with a 580 is just automatically going to get approved, right?
Right.
Typically, people that's credit scores are that low have some other issues, and some of those may be disqualifiers, regardless of score.
Bankruptcy or something like that.
BKs, foreclosures, or short sales, or just things of that nature. Okay.
Sure.
Um, what we're talking about here mostly though would be somebody utilizing FHA simply for keeping the low down payment, right?
Right. Right.
Maybe not needing FHA because of their credit score, but more so needing FHA because it allows for a low down payment on a 2 to 4 unit,
So
right?
take more leverage, which is more debt, save some cash for the improvements that you plan to make to the units, right?
Yep.
Re-rent them, move into another unit. I mean, that's how we did it.
Yep.
So,
Yep.
I don't know. It worked out well. Like I said, it feels like a different market. I wish we would have done them
Sure.
again, but
Yeah, but I mean, this market has continued to appreciate. It maybe hasn't been,
totally
the rocket ship that it was from the time you bought it, but
right.
it's continued to improve. And I've seen more guys like yourself get into, dip their toe into real estate investing that maybe wouldn't have in another market, right?
Yeah,
Just because the opportunity is there.
yeah, and the rates are so low.
Yep.
So are there things someone can do now to sort of move in that direction? Like you said, I mean, it's the lowest uh, qualification that you need to achieve, right? But like, say
Mhm.
somebody does have a bankruptcy, or say somebody does have a foreclosure, like what, or they can't meet that credit score. Like, what can they do now to put themselves in a position?
I would strongly recommend they talk to a lender as soon as
Okay.
possible, because it will be
Okay.
very case specific, right? I mean, we
Sure.
can talk some broad strokes here, but we're going to want to see, like, okay, did you have a foreclosure? When was that foreclosure actually dismissed, right?
Right.
Same thing with a short sale, or a BK. Like, we need to see when that judgment was filed. Um,
Okay.
so that we can determine those timelines. It may be that they don't have, any of those big monumental derogatory events on their credit, but they may just have credit card debt, right? That's been weighing them down. Okay.
Sure.
And it's driving their scores down. Um, again, what I like to do, or what I like to do when I'm pre-approving someone, is look at the holistic picture. Like, what is your full financial picture, right?
Right.
If somebody comes to me and says, "Oh, I want to buy a house and I want to put 20% down," but then I look and they've got $30,000 in credit card debt, I often am going to show them, look, you can still buy that house with only 5% down, or 10%, or FHA with 3.5% down, but use that other money to pay down your credit cards. Like,
Right.
utilize your borrowing ability wisely, right? You can borrow a 30-year mortgage right now at under 3%. Your credit cards, you're probably paying 15, 16% on, if not more.
Yeah. So if somebody wants to get in it, right, I mean, talking to a lender, they can't do too soon. I mean, you can help them prepare for a year down the road if that's what it
Can
takes.
never talk to a lender too soon, honestly.
Right.
And you
Right.
can never get pre-approved too soon. A lot of times people come to me and say, "Oh, I don't want to get pre-approved because I don't want you to pull my credit, and I'm not looking to buy something for 6 months or a year." Look,
Right.
get your credit pulled now. Like, make sure
Yeah.
you understand exactly where you're at, and what, if there is an issue or some sort of a roadblock, what your path to success is, there, because it's a lot easier for us to fix or to navigate those roadblocks when we have time. Whereas
Sure.
if you fall in love with the property, or like this awesome investment opportunity just pops up that you hadn't anticipated, or that you had kind of held off on getting pre-approved because you didn't want to get your credit pulled, um, and then all of a sudden we pull your credit and there's an issue and you want to buy this property, that can legitimately block you from that,
Right.
right?
Right.
Whereas if you're out in front of it, there's plenty of time to get it figured out. Also,
Okay.
like, it is a big, big overblown myth that somehow getting your credit pulled is some, like, terrible thing for your credit. Okay.
Okay.
I mean,
That's good to know. Yeah.
I have this conversation daily with people that say, "Oh, I want to get I want to buy a house next year, but I don't want to get pre-approved now. I don't want you to pull my credit because I don't want to buy something for 4 months or 5 months or 6 months." There is nothing wrong with getting your credit pulled. Okay.
Okay.
What you do not want to do is have your credit pulled repeatedly, right? So you don't want me to pull your credit and then you go down to a car dealership and apply for a car loan, and then apply for go to Best Buy and apply for a Best Buy credit card all at the same
Right.
30 days. That
Or
can have
get
a
or get
negative impact.
multiple pre-approvals from multiple lenders, right? That's going to
Right.
be the same thing,
Totally.
correct?
And even that's not the end of the world, as long as you're keeping it to, like, I usually say one or two in a
Okay.
90-day window. Okay.
Gotcha. Okay.
Um, and for me to get you pre-approved today, like, it's very often people will say, I want to buy something in the spring, right? Like, in, November, December, people were calling me to get set up to buy something in 2021. And they say, well, I don't think I want to move on anything till March or April. Well, a credit report's good for 120 days. But if I pre-approve you today and we go to April, say, and you haven't bought anything yet, I'm not going to keep pulling your credit every 120 days. I
Right.
know that, here on January 4th, we pulled your credit and it was great, right? And there was no issues. When you go and find something, or get back to being active again in April or May, we're going to wait for you to find that property. Okay. We're not
Right.
going to just keep pulling your credit, right? So we've
Right.
got a pre-approval letter for you. We'll refresh it as need be, but not
Okay.
until you find that property are we going to pull your credit again. And
Gotcha.
having your credit pulled by a mortgage lender 2 or 3, even probably 4 times a year, is not going to have some major impact on your credit.
Okay.
Um, and there's really no way to know exactly what you've got without pulling your credit. Okay.
Right.
Free credit reports, Credit Karma, Discover Card, people, say, oh, I bank with Chase, I get a free credit report. They're useless. They're meaningless. They're good for monitoring to make sure that no one is doing identity theft, right?
Right.
Nobody's taking out stuff in your name that you weren't aware of. But credit scores are generated differently. They have different algorithms for different types of credit. Okay.
Okay.
And really no one knows that. It feels like I've never had anyone understand that.
Right.
And the point being is that if I pull your credit and then you go to a car dealership and they pull your credit, they're going to get a different score than me. And the reason is those algorithms are weighted differently for different types of credit. So obviously the housing industry, the mortgage industry is going to give a lot more weight to what your housing past or history has been, right?
Right.
If somebody
Right.
has a collection on a utility, that will have a bigger impact on a score that I pull than it would on a car dealership.
Interesting.
Okay.
Okay.
So it's just one of those things that it's like you can sit there and speculate, right, and run your numbers and think what that you're preparing yourself, but until you've talked to an actual mortgage lender who does this every day and have your credit pulled and get truly pre-approved by them, looking at your tax returns and your income and your assets, you're really kind of just operating in the dark.
Okay. So lesson is just talk to somebody, get it pulled, know your position right now or as soon as possible, and that it shouldn't really impact you when you do want to buy. Or I mean,
It
it's only going
shouldn't.
to help.
It
Yeah.
shouldn't. I mean, if you've had major credit issues in the past and like what your credit issues are, that may be a case that you want to actually have a conversation with the
Right.
lender about that first
Right.
before. Because I would, in that case, I might say, well, let's really look at your timing, and I'd ask you like, what are your current credit card balances? Like, let's make sure that we're doing everything else we can so that when we pull your credit, it is best positioned, right?
Sure. Sure.
But if you just think your credit is good, get your credit pulled by
Right.
a lender, you
Right.
know,
Right.
like
Okay.
like do it. I mean, we see it all the time where people have a late payment on a gas credit card, right? Like on a, Conoco card or something like that that they didn't even know about, right? They maybe don't even use the credit card and it has an annual fee that they forgot about. It's $15 late payment that they never even realized, and it's been running now for 3 months, right? And that can be a crusher if you want to buy something quickly, right?
Right.
If
Right.
you're 4, 5, 6 months out, that's something we can probably fix.
Right. Okay. Well, that's good information. Specific to the FHA, can you get a cosigner?
On FHA, you cannot get, well, I take that back. So on FHA, you technically can get a cosigner, but on these multi-units, it's really not going to help you from a qualification standpoint.
Okay.
Okay. The purpose or the real benefit to a cosigner is to get um, to get more income to help support you, right? So sometimes people will say, oh, my credit's bad, but my mom's going to co-sign with me and she's got excellent credit. It's always going to take the lower credit score.
Oh, really?
Okay.
Okay.
Yes. So you'll never be able to just get a cosigner to get a better credit score out of
Gotcha.
it. Okay. The real benefit of a cosigner is being able to get more income to help you qualify. Right. So if somebody's, newly out of school, for instance, and they're going to be making more money soon, but they're not making enough to qualify right now. Right.
Right.
Having a parent or a family member cosign can be helpful.
In that
Um,
in
yeah.
that same breath, can you can use the income from the units, correct? Or a portion of it. I
Correct.
think what
And that was going to be my next point. And so typically with the multi-units like this, a cosigner really isn't necessary because you will be able to use um, the rental income from the other units to help you qualify, to help you offset. And that's why, especially for first-time home buyers, going this 2 to 4 unit route can be a really smart, financial decision because you can afford more property, right? You
Right.
can afford a higher price with less down because you have rental income coming in. So,
Right.
I see it all the time where we'll do people that were maybe looking at a single family in like the $400,000 or $500,000 range, right? And it was going to cost them a couple grand a month with taxes and insurance. Um, all of a sudden push up to the 550 or 650 range because now they got some rental income coming in, and now their actual housing payment after rental income is
Goes
only
down.
$1,000, right?
Right.
It's only
Right.
15, and they're living in a sweet spot, for only $1,500 a month because they got rent coming in, and maybe in a
Right.
more desirable neighborhood than they would have been able to get in, right?
So yeah, so I just want to clarify that because it's so interesting. Like if you're buying a single family home, you cannot do that. But the second you buy more than one unit on the same loan, so you've got obviously got to have a unit that I can live in or the buyer can
Mhm.
live in, right?
Yep.
Because you've got to be able to live in it. So one of those units needs to be vacant. But then the other three units, if it's a 4 unit building, I get to take a portion of their rents, apply it to my income, and help me qualify to buy that property, which is, sort of unheard of. Like, how
Yeah.
cool is that?
Yeah, no, it's awesome. It's awesome. And you find a lot of multi-units out there that maybe are like, say it's a 3 unit where two of them are smaller apartments, but one's called the owner's unit, right? And so
Hmm.
it's still a big, nice place, right?
Right, totally.
Or like you talked about is, look, if you have a little bit extra money and you can use this to put less down, or you have that other money to, be able to do improvements, to do
Right,
work on it, right? So
right,
maybe it's not like, maybe it's not the perfect dream home for you right now, or that unit is outdated and, it's not necessarily ideal for you and your family at this time. At least you can put less down and use that money to update the bathroom,
yeah,
update the kitchen in that unit. Now you make it like a really nice place, right?
right,
And
right.
so you went from, maybe buying a condo on your own to now all of a sudden you've got your own condo within a building that you own, and
Yep,
you're able to make it a lot nicer,
yep,
right?
yep.
And
You
not
kind
pay
of
HOA
start that
dues and
path,
other stuff.
exactly.
Yeah,
Yeah.
for sure.
Um, so can the down payment be gifted?
It can. Yes.
Okay, with
Yep.
FHA and with conventional
And
loans as
conventional.
well?
Yep. On a
Yep.
primary residence. Very
Which
important.
still can consider the 2 to 4 unit space,
Correct.
correct? Yeah.
Correct.
Okay.
Correct. Yep. If you are
Um,
buying a property strictly as a rental property as an investor, you cannot use a gift for down payment.
Gotcha. Um, and no LLCs, right? It has to be in your personal name.
Correct. That would be commercial lending, right? So
Okay. Yep.
sometimes people really want to buy investment properties in an LLC. Even if it's less than 5 units, they would have to get a commercial loan.
Okay. And so FHA or conventional, how many loans can I personally have in my name? Right? So let's say I want to do this a dozen times. Can I do it a dozen times or
So Fannie Mae, Freddie Mae, FHA, you can only have one, right? So that's out after that.
sure.
You can only have
I
one
got to
FHA.
refinance it, but I can
Right.
still keep using
Correct.
FHA. Yeah.
Correct. Yeah, and you're going to run into, just to be perfectly, upfront and transparent, you're going to run into an issue at some point if you're trying to do FHA repeatedly.
Totally.
Okay.
Yep.
Even if you're refinancing out of it, it's just going to become a questionable thing, right? The
Sure.
intent of
Totally.
FHA is to promote homeownership, right?
Right.
To help people get into this market, but it's not supposed to be an investment vehicle, right?
Okay.
So again, there are circumstances like we talked about where you could have bought an FHA and had a great appreciation and refinanced it to conventional and then go get another FHA. I
Yep.
just would never encourage or tell someone to expect to do that repeatedly.
Totally.
Okay. Um, but to
So,
answer your question on number of finance units, Fannie Mae
right.
and Freddie Mac, so conventional financing will allow you to have up to 10 finance properties.
Okay.
Okay.
In
And
my
that's finance.
personal
I
name,
mean,
in my own,
you have a loan on it, right?
right.
So you can own 15 properties if 5 of them are owned free and clear,
Right. Right.
you know.
So if I'm married and which I am, and but if my spouse wants to go get 10 properties as well, right?
Mhm,
I'm
mhm,
just trying to think through this, right? Like in theory, I could buy 10 in my name,
for
and
sure.
and that's anywhere from 10 to 40 units, right? And then my
Yep.
spouse can go do the same thing. So I mean, we could have close to 80 units if we wanted to, if we had the cash to put into it, correct?
Yeah,
In
so
theory.
it is cumulative. And what I mean by that
Gotcha.
is if you are going to buy another property and you want to get a loan on it and you already have 9 finance properties and your wife has 5 and you need her on the loan to qualify,
Right.
that would be a disqualifier because it
So
would
it has to
become
be qualified each individual person, correct?
correct.
Gotcha.
Correct. But if she's not on the loan, right? If you qualify
Yeah.
on your own, no problem, right? Then you
Yeah.
would be at that 10 mark.
So help me understand how are when you qualify me for the loan, right? Am I able to how does the mortgage obligation, the debt obligation work on that one property, right? When I go buy another one, if I've got sufficient rent to cash flow that property, does that offset? Like, how does that actually work to qualify it?
Yeah, your rental income will offset your debt on those other properties. However, it's going to be based off of what you're declaring on your tax return. Okay.
Okay.
So people will come to us often and say, look, my mortgage and taxes and insurance are $3,000 and I'm bringing in $4,000 a month in rent. Okay. That doesn't mean that I'm automatically, offsetting that plus giving you $1,000 in income, additional income from that property. Okay.
Right.
Because when you file your tax returns, one of the really great benefits of owning real estate is you get some excellent tax deductions.
Yep.
Okay. And it's your accountant's job for you to pay as little in taxes as possible.
Right.
But oftentimes when we look at how you're declaring your rental income between your expenses and your write-offs and whatnot, you're not operating on such a profit that you may be on a day-to-day, right? Or a
Sure.
month-to-month basis,
Sure.
right?
Sure.
So typically we see if the property's rented all year and it's doing well and you're cash flowing on it, typically we'll see from the tax return calculation that it's enough to offset your payment on
Okay.
there. Okay. Typically, there's plenty of cases when it's not, when we may still be hitting you for a loss of $500 a month or
Mm-hmm.
$1,000 a month because of the way that you're filing your taxes.
Which
Um,
directly impacts what I can qualify for, right?
Correct. What you can qualify for on the next place.
Yeah.
Absolutely. So
Okay.
it's important to keep that in mind. And again, if it's something you're going to like, if this is a side business or hustle that you're doing, you want to make sure you're talking to a lender that's helping you understand like what those implications will be
Right.
as you file your taxes as you move forward.
Is there a product out there that's better than FHA that somebody would like? Would I? Is there something that I could go qualify for conventionally that would keep my down payment low? I mean,
No,
is
I
there,
mean, as far as down payment goes, and that's really kind of what we're focusing on here, as far as down payment goes, there's nothing better than FHA.
okay.
Okay. And again, it's a certain time of your life, right? There has to be
Totally.
certain circumstances going on, right? If you're married with kids and live in a single family home,
Yeah.
your opportunity to buy a 3 or 4 unit with a 2-bedroom apartment, right, is probably gone, right? That ship has probably sailed,
Right.
right? And the same goes from an underwriting perspective, right? If you live in a 4-bedroom single family home with a 2-car garage and you tell me you're not going to sell that house but you're moving your whole family into a 2-bedroom apartment building,
Right.
we're probably not going to buy that as this will be an owner occupied property for you. Okay.
Okay.
It has to make sense. Again, it's the spirit of the guidelines, and guidelines meaning that FHA was created to promote homeownership. I mean, it is backed by the government,
Yeah.
right? To promote the American dream, to help
Right.
people who don't have enough money for a down payment, to help people who maybe have had some bad credit history but are improving it, right? It wasn't created in the spirit of an investor, right? That's just not what it's there for. Now we can use it, and that's what we're talking about here. We can utilize it, and you
Right.
should if that opportunity arises. But there's not anything better than FHA as far as down payment.
So let's say I don't want to use FHA. What are my other options? Is it 20% down, 25% down? What am I looking at?
So if you're looking at a conventional
Right.
owner occupied, again, staying with owner occupied, you can do a 2-unit with 15% down.
Okay.
Okay. When you go to 3 and 4 unit, you're going to be at a minimum 20% down
Gotcha.
for conventional.
Okay.
Okay.
That can still be gifted then too,
Correct.
if you've got
Yep.
family who wants to help
If
or
you've
a
got
partner
family
or
that
something.
want, yep, for
Yeah.
sure.
Okay. All right. Is there anything else that, an investor who's just starting out from the lending perspective needs to understand that we haven't covered here, or, I mean, that you have conversations with, or somebody who wants to do this house hack thing? Like what else should they know?
I think you've asked a ton of really good questions here,
Okay.
and we've covered a lot. I would say, pretty comprehensive. Again, I feel like a broken record, but especially when you're getting into this world of 2 to 4 unit properties, and you're considering, maybe doing this a few times, like it cannot be more important for you to actually talk to a lender first.
Yeah.
There can be so many different nuances to this that just jumping on Google and trying to research it yourself is not going to be sufficient,
Right.
right?
Right.
And probably even listening to this call isn't
Right.
going to
No,
be
totally.
sufficient, right? Like I got to look at your whole picture to
Yep.
start help you understand what you would qualify for, right?
Right.
Somebody calls me and says, well, what am I pre-approved for? What can I afford? Well, it's going to vary greatly depending on the property, right?
Sure.
It's like if I can tell you qualify for a single family up to $500,000 pretty easily, but if you find a 2-unit for $650 and it's bringing in $2,000 a month in rent in the other unit, that's a whole nother story, and that's
Right.
going to continue to change. So when people are calling me for multi-units like this, I can't really just write a blanket pre-approval saying you're
Mhm.
pre-approved at $800,000, because
Right.
if you find a place for $650 but it's got really low rents, I might not be able to qualify you for that.
Yep. And
You know,
one thing too, I want to reiterate from the real estate side of things. I mean, we're in a hot market, so it's one thing to actually get pre-approved, right? It's another thing to
Mhm.
get your offer accepted.
Yeah,
And getting an FHA loan accepted is particularly difficult because you're putting down so little. So, when I was successful with it and did it, like I said, it was a different market ago. The property wasn't selling, it was sitting there. So the seller was willing to take a
yeah,
chance on me, right?
yep,
And we can shape that and, just talk about, create the narrative that debt is cheap and you don't want to borrow as much and all that. But
yep.
like I said, there are still some challenges with that. So, um, a couple lessons learned here. The 2 to 4 unit it's a dynamite vehicle to get started in real estate investing, and you can do it with as little as 3.5% down. You do absolutely want to talk to a lender, ideally who has done these sort of properties before. But I think if anybody has any other questions or you want to know anything else, please feel free to reach out to myself or Drew specific to the lending needs. But Drew, this was awesome. Thank you very much. And I know my contact who asked these specific questions will appreciate it greatly. So thank you.
Awesome. Yeah, I appreciate it. Thanks, Jason.
Yeah, thanks.